Welcome to the Fintech One-on-One podcast, episode number 364. This is your host, Peter Renton, chairman and co-founder of Lendit Fintech. Before we get started, I want to talk about the 10th annual Lendit Fintech USA event. We are so excited to be back in the financial capital of the world, New York City, in person on May 25th and 26th. It feels like fintech is on fire right now with so much change happening, and we will be distilling all that for you at New York's biggest fintech event of the year. We have our best lineup of keynote speakers ever, with leaders from many of the most successful fintechs and incumbent banks. This is shaping up to be our biggest event ever, as sponsorship support is off the charts. You know you need to be there, so find out more and register at lendit.com. Today on the show, I'm delighted to welcome Kareem Saleh. He is the CEO and founder of Fairplay. Now, Fairplay is a really interesting company. They're doing something that really hasn't been done before. They're taking AI-based underwriting models and adding a fairness layer to them. So they call this fairness as a service. We obviously described that in some depth. Kareem sort of has a really interesting background and founding story about how this all came about. But the reality is lending today is still unfair for many, many populations. And he has a fantastic map on his website we talk about. We talk about how they're addressing it. What are the things they do to make sure that fairness is really front and center, while at the same time, protecting performance. And so we go into that in some depth. He talks about what's been happening in government lately and how they are sort of interacting with government. He talks about his wonderful group of advisors, which have a whole bunch of rock stars on there, and much more. It was a fascinating episode. Hope you enjoy the show. Welcome to the podcast, Kareem.
Thanks for having me, Peter. Delighted to be here.
Okay, great to have you. So let's get things started by giving the listeners a little bit of background about yourself. You've had some interesting things you've done in your career to date. Why don't you give us some of the highlights?
So I've been working on underwriting hard-to-score borrowers my whole life. And that started at a very young age, actually, as a result of my family's own experience with exclusionary lending. My parents are immigrants from Africa. They moved to the States in the early 70s. And it's a kind of classic American immigrant story. They were highly educated in their home countries. They spoke the Queen's English, moved to America, needed a modest loan to start a small business, and couldn't get one. And that kind of had very profound effects on our family. And it kind of struck me that from a very young age, that credit is the sine qua non of modern life. So I started working on this question of how to underwrite hard-to-score borrowers, how to underwrite under conditions of deep uncertainty, people with thin files, no files, some kind of credit event in their past. I got started doing that work in frontier emerging markets, sub-Saharan Africa, Eastern Europe, Latin America, the Caribbean, and then spent a few years at an unfortunately named mobile wallet startup called ISIS that was mercifully rebranded Softcard and sold to Google. And then for several years in the US government, at the State Department and at the Overseas Private Investment Corporation. And that gave me visibility into the underwriting practices of some of the most prestigious financial institutions in the world. And what I was quite surprised to find was that even at the commanding heights of global finance, the underwriting methodologies, at least at legacy institutions, were still quite primitive. Mm-hmm. And almost all of the decisioning systems in use in financial services exhibited disparities, against people of color, women, other historically disadvantaged groups. And it's not because the people who built those models are people of bad faith. It's largely due to limitations in data and mathematics. But Part of what interested me about that was, ostensibly we have a legal regime in the US that prohibits that kind of discrimination. And so I started wondering a little bit about how is it possible that on the one hand, discrimination is illegal, and on the other hand, it's ubiquitous. And that was the animating question behind the founding of our company, Fairplay, which is what brings me here today.
Right. Was there some sort of catalyst to launching the company? I know you were working at another company in the space beforehand. What was sort of the catalyst to start Fairplay?
As somebody who's interested in underwriting, one of the things that me and my colleagues make a practice of doing is reviewing advances in the academic literature to see if there are new mathematical techniques that might, give us or our customers an underwriting edge. And so about 3 or 4 years ago, we started to see the emergence, largely from places like Carnegie Mellon and Stanford, of new mathematical techniques that are sometimes called AI fairness techniques. These are techniques that are designed, to do a better job of underwriting populations that are not well represented in the data. And so about 4 years ago, as we were reviewing these papers, we persuaded a major mortgage originator to work with us to do a pilot to apply some of these new AI fairness techniques to their mortgage loan underwriting. And we were surprised to find that that mortgage originator could have increased their approval rate for Black applicants by something on the order of like 10% without any other corresponding increase in risk. We found that these new AI fairness techniques had great potential to enhance inclusion, and yet virtually nobody was using them in financial services. And then it was around that time, shortly thereafter, that we all witnessed the murder of George Floyd. And so in the summer of 2020, as the Black Lives Matter movement was sweeping across the country, and there were protests in the streets over the murder of George Floyd, me and my co-founder, John, started asking ourselves, as I think many people in the industry did, what can we do to ameliorate systemic racism in financial services? Our conclusion was that we could bring these new AI fairness techniques through what we call fairness as a service to allow financial institutions to debias their digital decisions in real time. And so that was the kind of backdrop that animated the founding of Fairplay.
Gotcha. Okay, so then let's just take a look at, people would say that we've made a lot of strides in underwriting in the last 10 or 15 years. We've seen the fintech lenders kind of come to the fore with new underwriting models. Do you think it's fairer today, even some of the AI-based underwriting models that are out there today? Is it fairer today than it was, say, 15 years ago when most underwriting models sort of had a human component? What do you think is the sort of state of play today?
Peter, the answer is very murky, right? And you can see this most clearly in the mortgage market. So the Black home ownership rate is the same as it was at the time as the passage of the Fair Housing Act, 50 years ago, right? So 50 years ago, we had judgmental underwriters making decisions about who to approve for loans. Those decisions are made by algorithms today, and yet the Black home ownership rate hasn't increased at all. So I would say, at least in the mortgage industry, there is a compelling argument to be made that the algorithms that are being used in underwriting are encoding the biases of the past. Now, certainly there have been a number of advances in underwriting in other parts of the consumer finance market. You have now, for example, installment lenders who are doing a better job of using alternative data, cash flow underwriting data, for example, which is supportive of financial inclusion. The question then is, though, okay, maybe that data is helping folks get approved for loans, but are those loans being priced fairly? So I would say the question around whether or not the move to algorithmic and automated underwriting has been supportive of financial inclusion is somewhat murky. In some asset classes like mortgage, clearly it hasn't had the effect that we hoped it would. In other asset classes like installment loans, I think we see approval rates going up in ways that are supportive of inclusion, but I worry that there might be pricing and collections unfairness that we have yet to fully uncover.
Right. So is the crux of the problem, is it a data problem that we don't have enough data or the right data, or is it sort of a model problem, methodology in how we analyze that data is wrong, or is it a combo?
I think it's both, Peter. I mean, certainly it's a data bias problem, right? If you take Black Americans who were historically excluded from the financial system, there's just not enough data about their performance in order for us to be able to make reasonable conclusions about their creditworthiness. And that's in part because to the extent that they were ever included in the financial system, they were often either gouged or steered towards predatory products. So certainly data bias is a substantial problem we have to contend with as an industry. But it's not just data, right? I mean, part of the bias is intrinsic to the mathematical methodologies that are being used too. Let me just give you one example. Almost all AI algorithms must be given a target, an objective, a thing that they seek to relentlessly maximize. Mm-hmm. And for credit algorithms, it's predict who is going to default. But if you take a step back and think about it for a minute, giving an algorithm a single-minded objective might cause it to pursue that objective without regard to other harms that it might create in the process. So let's just take the Facebook social media algorithm as an analogy. You know, the Facebook social media algorithm is known to prioritize engagement. It will relentlessly seek to keep you engaged, regardless of whether or not the stuff it is showing you to keep you engaged is bad for your mental health or bad for society, right? If you think about self-driving cars, if Tesla gave its self-driving cars the single-minded objective of getting a passenger from point A to point B, the self-driving car might do that while driving the wrong way down a one-way street, while blowing through red lights, while causing other mayhem along the way. So what does Tesla do? Tesla gives the neural networks which power its self-driving car systems two objectives. Get the passenger from point A to point B while respecting the rules of the road. And we can do that in financial services. That's what we've done at Fairplay. We have taken a page from the Tesla playbook and built algorithms with two targets. Predict who is going to default accurately while also minimizing disparities for protected groups. And the good news is it works. When you give these algorithms an additional priority, there's a lot of low-hanging fruit in terms of unfairness that they can find to remedy without sacrificing accuracy.
Okay, so you're basically taking existing, because there have been a lot of sophisticated models that have been created, AI models that are maximizing for overall return, which is really maximizing for no defaults, and you're adding a fairness piece. So maybe can you sort of dig into that a little bit more? Like, how do you do that?
So in our case, what we have done is to treat unfairness for various protected groups as another form of model error. So typically when you are constructing a model, especially a machine learning model, you use something that's called a loss function. And the loss function is what tells a model if it is learning correctly. And it penalizes a model when it learns the wrong stuff. So for example, if during the training process, a model starts approving a bunch of applicants who would have defaulted, the loss function sends a message back to the model and expresses that the model must revisit its reasoning because it is not doing a good job of underwriting those applicants. It is making errors in its reasoning when underwriting applicants. And so what we do is we modify a loss function to include a fairness term so that during model development, as the model is learning who will pay back their loans and who will not, it does so with some sensitivity to the fact that there are historically disadvantaged populations that might not be well represented in the data, and that the model should do its best to make sure before it discards one of those applicants that they don't resemble good applicants who would have paid back their loans on some dimension that the model did not heavily consider. Let me unpack that a little bit.
Okay.
One variable that we often see in credit algorithms is what is the consistency of the applicant's employment? And if you think about it, consistency of employment is a very reasonable variable on which to assess the creditworthiness of a man. But consistency of employment will always discriminate against women between the ages of 20 to 45 who take time out of the workforce to have families. Mm-hmm. So what we do is we train the models so that when they encounter somebody that they are about to decline for inconsistent employment, rather than let that inconsistent employment be outcome determinative, the model should run a check to see if that applicant resembles good applicants on other dimensions. Have they ever declared bankruptcy? How desperately are they? Do they appear to be seeking credit? Do they have strong stability of residence? Is the number of professional licenses they have increasing? There might be all of these other dimensions on which the applicant resembles good borrowers, notwithstanding the fact that they might have the occasional gap in their employment. Does that make sense?
Yeah. So when you say fairness, you are not just saying racial fairness, you're saying different types of fairness. Is that fair to say?
Yes. Well, so technically under the Equal Credit Opportunity Act, the government recognizes 6 protected classes.
Okay.
And you can be protected on the basis of race, age, gender, national origin, disability, marital status, whether or not you're a service member. We define fairness broadly to include all of the protected classes under the law, but then other folks who might not technically be protected, but that we still think deserve a fair shot. So, for example, thin or no file applicants.
Mm-hmm. Gotcha. Okay. So what you're doing is you're taking your model and you're really optimizing, I can see, for more than one thing. It's like, go to the Tesla kind of analogy you made. Like Tesla could optimize to getting A to B as quickly as possible, and it could endanger people. So you're adding these other pieces. The goal is still to get from A to B. The goal is still find good borrowers who will not default and who will perform well. But are you also taking into account, like I think you mentioned before, pricing? Is that part of what you're doing, or is that beyond your purview?
It is. So we believe, and the law requires, that various decisions across the customer journey must be made fairly. And so if you think about, the customer journey in lending, the marketing decision must be made fairly, fraud detection decisions must be made fairly, underwriting decisions must be made fairly, pricing decisions must be made fairly, account management decisions, things like line assignments for credit cards, must be made fairly. And of course, collections must be done fairly. So we think that there are a number of high stakes decisions across the consumer lending journey where there are fairness issues, and those decisions must be made fairly.
Gotcha. Okay. And so you mentioned differences between like home loans and personal loans. Are there big differences in the different lending verticals? I'm thinking of, credit cards, there's auto loans, there's student, obviously there's mortgages. What are you seeing there?
What we observe is that there are fairness issues of different kinds in almost every consumer credit vertical. So we talked a bit about mortgage. In mortgage, you can see nationally Black applicants are denied at twice the rate of white applicants. So I would say in the mortgage market, we have an approval rate problem. But in the auto loan market, virtually nobody is denied. Almost everybody is approved for auto loans. The question is, what are the terms that you are offered on those auto loans? And as we know, there has been some concern, for example, about things like yield spread premiums and dealer markups. And so in auto, I think the question isn't an approval fairness issue. It's a pricing fairness issue. We see the potential for fairness risks in almost every consumer credit product we touch. It's just that they may be at different stages of the customer journey.
Right. I want to talk about this fairness map you have on your website, which there's a tool that you have. I went down to my city that I live in and looked, and you actually isolate some of the areas within the city that are more fair and less fair. And it's a really interesting tool. And looking at my city, I could see the areas where it was picking up things that I feel like are in reality on the ground. What are you using to create that tool?
As a result of the Home Mortgage Disclosure Act, every mortgage originator in the country is actually required to submit certain loan level information to the government every year. And the government, in theory, makes that data available to the public in something called the Home Mortgage Disclosure Act database, so that the public can understand if a particular lender is engaging in, let's say, redlining. But of course, it's the US government, so they make that data available in like the least helpful format possible. The mortgage fairness maps actually started as an internal tool. The best products, it seems, always start as internal tools, because we would be getting ready to meet with prospective clients, and I would want to understand something about their fairness before the calls. And I would say to my team, can we please go pull the mortgage records from the HMDA database for this particular lender? And I would get sent a spreadsheet that I could neither make heads or tails of. And so after about 5 or 6 episodes like this, I had a minor nervous breakdown, and I asked my team, I told my team, I want you to just go scrape all of the data in the Home Mortgage Disclosure Act database going back several years. And I want us to build an interactive map that represents the state of mortgage fairness in America, as you point out, all the way down to the census tract level, to the block group level. I want to understand block by block, what is the state of mortgage fairness in America? And as you can see on the website, www.fairplay.ai, the state of mortgage fairness in America for Black and Native American applicants in particular is quite bleak. And one of the kind of disheartening things about the map, the state of mortgage fairness for like Hispanic Americans isn't great. Hispanic Americans tend to be approved at like 85% the rate of white Americans compared to 75% the rate for Black Americans. But what's interesting about the Hispanic map is the more Hispanic your neighborhood, the fairer the mortgage market is to Hispanics. So if you look at Southern California, Southern Florida, where Hispanic populations predominate, the mortgage market is really fair to Hispanics. What caused all of our stomachs to turn was, if you look at the Black and the Native American maps, we observe the opposite effect, which is to say, the blacker your neighborhood, or the more likely you are to be on an Indian reservation, the less fair the mortgage market is to those groups.
It's staggering to see. I mean, you've got it on your homepage here, and like some southern states have almost their entire state that is blanketed as unfair. It's really quite staggering.
The message that all of this drives home to me is that those lending decisions used to be made by humans. They are now being made by algorithms, and the algorithms appear to be replicating the disparity of the past.
Right.
In many parts of the American mortgage market, and this is a controversial statement, Black applicants are treated as if there were still a 3/5 clause in the Constitution.
Wow. Yeah. Well, it's great to identifying. They say awareness is always the first step, right? So,
it's funny that you use the word awareness, because one of the things we say at Fairplay is for the last 50 years, we have tried to achieve fairness in lending through blindness. This idea that if we blinded ourselves to the protected status of the applicant, that we could rely on variables that are quote unquote neutral and objective to increase positive outcomes for those historically disadvantaged groups. And as I think I've said earlier on the pod, the Black homeownership rate today is exactly what it was 50 years ago. So fairness through blindness hasn't worked. One of the things that we advocate at Fairplay is what we call fairness through awareness, which is precisely what you said, right? This is the idea that maybe we ought to be using information about these historically disadvantaged groups in a privacy-preserving and responsible way to see if we might not do a better job of bringing them into the financial system.
Right. So you've been around for less than 2 years, but I'd love to get a sense of, can you tell us some of the lenders that you're working with today?
I'm happy to report that since our founding, I think we have fast emerged as the default fair lending solution for the fintech industry. American Banker has reported that both Figure Technologies and Happy Money are Fairplay customers. And I'm delighted to report that we're going to have several other big names that we're going to be able to announce publicly soon. But the good news is we're growing very fast, and we're seeing rapid adoption across the fintech industry by folks in mortgage, auto, power sports finance, credit cards, installment device lending. You name the consumer credit vertical, and there's a good chance there's a Fairplay customer there using our software to optimize their decisioning systems to be fairer.
That's great. That's great. Because look at some of the things that are coming out of the CFPB in the last couple of months. And they've been talking, I mean, like it was just last week where Director Chopra was testifying in front of the House and Senate, talking about one of the things he talked about, many things, was being tough on these AI lending models, algorithmic lending. It doesn't seem like he's a big fan. Has that made the conversations you're having with your customers, like with the lenders, are they more receptive to your message now than they were, say, a year ago?
I think so. I think everybody who pays attention to developments in Washington can see there is a new sheriff in town. Fintech is in the crosshairs. And there is a perception that the algorithms that are being used in the industry, left to their own devices, will discriminate against historically disadvantaged groups. One of the things that we hear a lot from clients these days is, hey, we know that we need to do a better job on fairness because the customers that represent the future of our business and the regulators are increasingly demanding fairness from the brands that they patronize.
Right. Yep. That makes sense. So then I imagine you're talking with government agencies yourselves. I mean, what are the feedback you're getting from your conversations with government?
We think that the regulators and policymakers, both at the federal and the state levels, are really trying to get up the curve and enhance their understanding of AI technologies and what their potential promise and the associated risks might be. And so we have taken it as kind of a competitive mandate, frankly, to maintain an active and intensive dialogue with the regulators on issues related to AI technologies and their governance and their fairness. So one of the things that we have done in that regard is published a piece recently with the Brookings Institution, setting forth what we call an AI fair lending policy agenda for the federal financial regulators, and setting forth what we believe to be the right ways to harness AI systems so that they can produce positive and inclusive outcomes in financial services and guard against the potential risk of those technologies.
Right. Do you think we should be doing more as an industry? Because, I mean, clearly there's risk right now with anyone using, and I imagine you're probably a little different, I'm guessing, than most of the other companies out there that really are touting AI lending because you've got such a focus on fairness. You're probably going to get treated a little differently, but should we be doing more as an industry to educate, policymakers in Washington?
I think so. I think that companies ought to be meeting with regulators to explain the technologies they're using and the steps that they are taking to ensure that those technologies do not pose a threat either to the consumers they serve or to the safety and soundness of the financial system. I have some sympathy for the folks in the government because the technologies have evolved and changed so rapidly that if you're not inside one of these lenders, that it is hard to keep your finger on the pulse of what's happening out there in the market. And so we were meeting with a lender a few weeks ago who said, this seems like a regulatory solution. I don't even know who the name of my regulator is. And it occurred to me that, it would be quite unfortunate for that lender to learn the name of their regulator for the first time sitting across the table from them facing down the barrel of an enforcement action, right? At that point, I think that lender will have wished that they had been more proactive about explaining what it is they're doing and why they feel it's appropriate and the steps they've taken to ensure its safety.
Right. I was telling you this before we hit record here, and you really have a fantastic group of advisors. I've had no less than 4 people reach out to me in the last couple of months telling me that I got to get you on the podcast. So here we are. You list some of the people on your website, but how have you been able to build such an impressive group of advisors?
We have always believed that in order to use these more advanced AI systems in a regulated industry like financial services, that the regulators were going to have to be with us. If they weren't with us on takeoff, they weren't going to be with us on landing. We made it a point very, very early on, even prior to founding of the company, to maintain an active and intensive dialogue with both current and former regulators, especially those who kind of live at the cutting edge of where regulation and technology interact. And so we have been extremely fortunate over the years to build relationships with folks like David Silberman, the longtime number 2 at the CFPB, Manny Alvarez, who in addition to being the general counsel at a firm, was also the California Commissioner of Financial Institutions, Dan Kwan, who led the innovation office at the CFPB and is responsible for the first ever no action letter issued by the CFPB, kind of blessing the use of AI in consumer loan underwriting. And I recently joined the Technology Council at the Alliance for Innovative Regulation run by Joanne Barefoot, who herself is a longtime OCC senior official, and I think has done some of the finest work really at the cutting edge of regulation and technology.
Yes, some of those are the people that actually have reached out to me. And a shout out to Dan Kwan, who was the first person to tell me that I needed to check you guys out. So anyway, I want to talk about the future here. And you talk about your mission is to build fairness infrastructure for the internet. So that's a little bit broader than just the lending space. So let's talk about where you want to take Fairplay.
Yeah, Peter, our view is that as algorithms take over higher and higher stakes decisions in people's lives, that the need to debias those digital decisions in something approaching real time will be essential. And so we think our software was developed to allow anybody using an algorithm to make a high stakes decision about someone's life to answer 5 questions. Is my algorithm fair? If not, why not? Could it be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to see if they might resemble good applicants on dimensions that the primary decisioning system didn't heavily take into account? Our tool is a tool of general applicability. So yes, we've gone to market in financial services because it's the domain we understand best. And there's a regulatory regime there that is supportive of fairness. But we are also making headway in industries like insurance, employment, government services, and even marketing. So our view is that just as Google built search infrastructure for the internet, and just as Stripe built payments infrastructure for the internet, so too will we build fairness infrastructure for the internet.
Okay, well, if you can build a company the size of those and the influence of those two, you're going to be doing really, really well for yourself. So, Kareem, thank you very much for coming on the show. Best of luck. It's a noble mission. You really are breaking new ground here. So congratulations on your success to date.
Thank you for having me, Peter. I've enjoyed the conversation, and I believe that Lend It is the must-attend conference for the fintech industry.
Okay, hear, hear. Thanks. Thanks again. See ya. You know, it seems staggering to me that here we are in 2022 where technology hasn't really solved this sort of discrimination and lack of fairness that many people experience in our financial system. So really commend Kareem and Fairplay for doing something new. This is something that I think is needed. And, you can see by some of the companies that are using Fairplay, and there's more that are going to be coming down and announced soon, that this is something that is sorely needed by the industry. And I think, it's going to help us dramatically in conversations that we have with regulators. And regardless, it's the right thing to do. And that's sort of what I came out of this conversation with. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.